Good afternoon, and thank you very much for being awarded the 2021 BME Prize on the Best Paper in Fixed Income Markets presented at the 28th Finance Forum. This paper, Safe Asset Carry Trade, is joint work with Angelo Ranaldo from the University of St. Gallen. And my name is Benedict Ballensiefen from the University of St. Gallen and the World Bank Group. So what do we do in this paper? We look at the temporal and cross-sectional variation in convenience premia. Our understanding of the asset pricing implications and also of the economic determinants of this variation is still very limited. And that's the gap in the literature which we try to address with this paper. In order to do so, we look at European repos. Why do we look at European repos? When you think a repo is in essence a short-term, one-day, over-collateralized loan that is secured by different types of government bonds. In addition, all repo trades in the euro area are conducted via a central counterparty. So we have a euro one-day over-collateralized loan traded via a CCP. So this means we're actually able to eliminate many confounding factors ranging from term premia to currency premia, and that allows us to really measure convenience premium differential. And that's the novelty of our study. Here we see the time development of European repo rates. We see the repo rates for Germany and France in the greenish lines, and for Spain and Italy in the bluish lines. I think there are a couple of important points. First, we see that repo rates for Germany and France tend to be lower, so those assets tend to carry higher convenience premia. Second, we see an increasing dispersion during the European sovereign debt crisis. So this means we see an increase in the safety premia embedded in truly safe assets. And we also see an increasing dispersion in or following 2015 in the negative rate environment. Interestingly, repo rates for Germany and France have actually fallen below the ECB's rate on the deposit facility. So this means banks are willing to lend in the repo market to obtain collateral at a rate that is lower than just storing the money at the ECB. So this clearly speaks to banks valuing the convenience benefits embedded in collateral assets. And this dispersion provides the motivation for our carry factor, which we form by going long in quasi-safe assets with higher repo rates, while shorting truly safe assets with lower rates. And here we see the time development of our carry factor that materializes kind of as a strategy of a cash neutral collateral swap. And we see there's variation with increases during the European sovereign debt crisis. And since 2015, when the ECB conducted asset purchasing programs leading to asset scarcity. So what is the contribution of our paper? First, we provide a first systematic asset pricing analysis of European repos, which is an important category of safe assets. And we propose a simple factor structure with a market factor and a carry factor. The market factor represents the average level of short-term interest rates, while the carry factor accounts for the cross-sectional dispersion. The second contribution of our paper is to explain the existence of our carry factor from the perspective of the safe asset literature. And as I said, the carry factor measures a convenience premium differential between truly and quasi-safe assets. And we link that to the safety premium and to the liquidity premium reflecting asset scarcity and opportunity costs. And lastly, we show that our short-term carry factor is actually able and helps explaining the cross-section on long-term government bonds. And with that, I would like to stop here and thank the organizers in BME again for receiving this award. Thank you very much.